Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, hello everyone, and welcome to this month's edition of the AWA Market Minute. Just a quick housekeeping item. Members of our advisory committee are monitoring our chat, so feel free to ask questions and we'll do our best to answer live during the episode. Scott, we've got some really fun stuff going on in the Coles residence. We took a trip to Nicaragua earlier this year with my kids and my wife, and everybody got this inspiration to learn Spanish. So right now we've got Duolingo going off. At night you can hear the app ding, ding, ding. And my kids are all working on Spanish. My wife was so inspired. She's actually taking formal Spanish classes now, which has been really fun for me because I speak Spanish. And so it's been fun to have this going on in the house. It's actually reminded me of, just how funny it can be when you miscommunicate, especially in a different language. And there was a story from years ago when I was learning Spanish that I thought would be a fun anecdote to share to introduce today's topic. So I was living in an area that was predominantly people of Mexican descent, and I had working with me an individual who was from the nation of Chile. And people in South America speak Spanish, but the dialect and words can often be different. And even sometimes the same word can be used with a totally different meaning. And so I had to learn that sometimes, you could use words that had different connotations and different meanings in different contexts. And so one of these events was, we were eating dinner in the home of a family that was from Mexico. And there's a word that is traste. And that word in the people from Mexico would use that to mean like dishes or plates. However, in South America, the same word would be used to reference like a backside, like your bum, right? And in other words, like if your little kid was misbehaving, you'd kind of give them a swat on the traste, swat on the bum. And so we're sitting at dinner, and my friend was from Chile, and the family that we were with was from Mexico. And the woman of the home who was serving us dinner after we'd eaten, she asked my friend Martinez, "Hey, can I take and clean your plate?" But the word she used was traste. So what Elder Martinez heard was, "Hey, can I clean your bum?" And boy, we all erupted in laughter. He didn't think it was very funny. We had to, back it up and explain it to everybody. Just this one word created some significant miscommunication, misunderstanding. And so it's got me thinking a lot about this idea of words and how, they convey meanings and how sometimes they can create misunderstandings. Today's conversation is going to be about politics, and that is a highly emotionally charged conversation. And Scott, you and I've talked a lot about how do we approach this conversation in a way that does not offend, right? And so right out of the gate, we want to ensure that you guys understand our intent today. We want to have an open discussion without offending. I know that kind of sounds like we're talking about going swimming without getting wet, but we're going to try our best to talk through, the policies and not politics of what's going on in this presidential election. And before we dive in, we want to establish some ground rules and address some common concerns. First, we recognize that finding unbiased information is very challenging. And anytime topics come up that are emotionally charged, there's a fear that someone will assume we're revealing our own political leanings, but today, guys, I promise that will not be the case. Secondly, during election seasons, politicians, media, and pundits will often use fear to stir emotions to sway votes. And we want everyone to participate in, their civic duty to support our democracy, but we're going to try our best to remove any fear mongering from all sides of this conversation. Now, many people are genuinely concerned about, the outcome of this election being catastrophic. And we understand those fears. And if parts of this discussion feel disconnected from those emotions, please know it's not out of ignorance. Our goal isn't to downplay anyone's concerns or appear naive, but we also want to avoid extreme reactions. We don't want to get in the habit of preparing for a worst case scenario that doesn't actually materialize. So our conversation today will be to explore historical and policy related data without falling into either camp of either panic or indifference. And hopefully, Scott, this conversation will provide some helpful insights as we navigate the coming weeks together.
Yeah, and I think that's a great way to set the table, Paul, for our discussion today. And I would just add, in the scope of presidential elections and everything that encompasses, that's a lot to unpack. And we are not going there. We don't have any desire to delve into that in great detail. We have a very narrow focus today, and our focus is going to be on the historical record as far as how markets have behaved with different presidential outcomes, and if there's any data or information that we can pull from that might be applicable to today.
That's awesome. So with all that disclaimer, guys, we're going to go ahead and make a stab at this. We're going to dive in to the financial headlines. So I read this article. I think this is fascinating. There's actually a market right now for gambling on the outcome of presidential elections. And the pool is up to $1 billion in bets on gambling on the pool for the presidential election outcome. And according to Barron's, and I read an article in the Wall Street Journal that talked about this as well, they're actually working to potentially shut this whole thing down. And the idea is, they're saying it's kind of akin to if an NFL or NBA athlete is betting on the outcome of their game they're participating in, where they have the ability to control outcomes. They're saying it's inappropriate, right? And so where we, the people, have the ability to participate in outcomes, they're saying it's inappropriate to actually allow them to gamble on that. I just think it's an interesting conversation.
So you're saying, Paul, if I bet on an election, I am Pete Rose. Is that what I'm hearing?
That's exactly the problem.
Okay.
So keep your money in your wallet. All right. Next headline.
Yeah, I thought this one was super interesting. So this was in the Jerusalem Post, and it said the BRICS challenge and the U.S. response, a new era of gold. And what this article spoke to was the attacks, if you will, that's perhaps too strong of a word, but the desire of maybe other countries to replace the U.S. dollar as the world's reserve currency. We field a lot of questions on this, and I think our long-standing perspective on this is the U.S. dollar isn't going anywhere soon. And the analogy we would use for this is the U.S. does have its warts, but the U.S. dollar is the cleanest shirt in a hamper of super dirty laundry. And until that changes, we think the U.S. dollar's position as the world's reserve currency is in place for some time.
Absolutely. And I think that's an important point as we do kind of get into the conversation on policies and politics and presidential outcomes, that we have a lot of confidence in the U.S. dollar right now. Let's go ahead and dive into the market update.
All right, since our last market minute, markets have continued to surge. The NASDAQ year to date up over 20%. Same with the S&P 500. That has primarily been driven by technology shares in particular. That's where the outperformance has been there. The Dow's up more modestly, but still up 11%, which is an incredibly solid year. The 10-year Treasury, the yields have actually come down from about 3.9% to start to the year to about 3.78%, which is about a 3% decline. So rates have been coming down, which is typically a good tailwind for markets and good for consumers as borrowing rates continue to go down. I've seen mortgage rates continue to drop. That's been a positive development. Oil is now in the red for the year, so the price of that commodity has gone down year to date. That's a good factor as far as being deflationary and also being something where input costs and theoretically fuel costs have come down a little bit. Gold continues to have a great run, up almost 30% year to date. And there's been a flight to safety kind of component of that. And then you've had countries buying quite a bit of gold as well. And that's pushed that price higher. And gold continues to break all-time records.
Scott, how much of the 10-year Treasury was being impacted by the Federal Reserve's rate cut in 2 weeks ago?
A little bit. The 10 years interesting because it's going to be a little more forward looking. So if the Federal Reserve cuts the Fed funds rates by 50 basis points like they did, that doesn't mean that the 10 year is going to go down by 50 basis points. The 10 year is anticipatory, and so it looked and said, hey, we think rates are going to go down. To the extent there's surprises, it can go down more or less, but the 10-year rate is suggesting that we will see several rate cuts in coming months.
Awesome. Good information. Let's dive into our roundtable discussion.
We thought we could kick this off with just some perspective around how presidential elections have impacted markets. And the chart we're looking at right here shows that how markets basically do in a normal presidential election year. And in an election year like the one we have this year, markets on average are up about 12.2%. So markets typically do well when it's a presidential election year. And that has certainly been the case this year, where we're up 20% on the S&P, 11% on the Dow. So we've had strong performance as far as that goes. And as we kind of unpack where polling is and where things are shaking out from that perspective, this is one tight election. So just for perspective, at this point in the 2016 election, Hillary Clinton was up by 3.1 points on Donald Trump. In the 2020 election, Biden was up almost 7 points on Trump, and Harris right now is ahead of Trump by about 2.1 percentage points. So right now it is a push as far as who's going to win the presidential election.
So Scott, I'm curious, why is it that historically the Democrats have needed to have a wider margin at this point in time in order to kind of feel confident in November?
Yeah, it's a great question. And so this relates 100% to the nuances associated with the Electoral College. You have California and New York, which lean heavily Democratic, have larger populations, so they can inflate the number in the popular vote while not necessarily moving the meter with the Electoral College. So the Democrats typically have to win by quite a few percentage points with the popular vote for that to shake out with the Electoral College.
Oh, that makes sense.
Yeah, and also we're looking, it's not just the presidential election, although that is the one that garners most of the interest. The Senate and the House are also tightly contested this year. Right now, the House looks like it's about a coin flip as far as who's going to win. The GOP has fewer seats to potentially defend at this point, but a lot of those seats are projected to flip, and so the House is going to be very close as far as that goes. The Senate is also close, although the GOP has far fewer seats to defend. If you look at the chart there on the left, the GOP has close to 50 shares. There's an investment advisor speaking for you. 50 seats that are pretty well locked up, whereas the Democrats have 44. And then there's 6 that are toss-up. And some of those races are incredibly tight. Ted Cruz's seat in Texas is incredibly tight. Tester's seat in Montana is also tight. And so the Senate is definitely leaning more GOP just on the basis of electoral math. But that one's awfully tight as well. So I think what this means, Paul, is we are looking at some form of political gridlock, either divided Congress or divided executive branch and Congress. We're looking at some type of divided government there.
And so I guess the follow-up question to that would be, with all these elections that are really feeling extremely tight, what are some historical outcomes that we've been able to witness given different political parties kind of having control over different different forms of government? Yeah,
great question, Paul. And this slide we're looking at here is one of my favorites as it pertains to presidents and the impact on the economy. So what we're looking at here is the S&P 500 performance based on when a Democrat is president and when a Republican is president. And you can see that the two bars for both the Democratic president scenario and the Republican president scenario have about 13% returns. And that's the case for both parties. And those are in keeping with having either totally Republican-controlled Congress or divided Congress. Those historically have been the best outcomes for market returns. Markets haven't done as well when you have 100% democratically controlled Congress. When there's a Republican president and a democratically controlled Congress, only about 5% is where that rate of return has been. And then when there's a Democratic president and a Democratic Congress, that number falls to about 9%. So I think what this speaks to, Paul, is yes, presidents matter in terms of market outcomes, but the composition of Congress seems to matter even a little more.
Yeah, and I think this is a really important point that we probably can't emphasize enough, and that is that when markets perform best, it's under political gridlock, right? And I think that the market really appreciates some predictability, where we can kind of understand what will come next. And when you have political gridlock, in other words, not a lot of stuff is getting changed. Not a lot of adjustments are happening. And so markets enjoy that because they can kind of say, okay, we can look ahead and predict how this is going to impact us. And that allows us to price in, what we think this growth will look like. And that's an interesting, correlation here. When you get divided Congress, it doesn't really show a significant impact between either presidency.
Yeah, and I think maybe a good case in point is think back to the Clinton presidency. Newt Gingrich was Speaker of the House. President Clinton was president, and they had a period of time there where they were really kind of dialed in as far as working together, and boy, the economy really surged under that regime. And so
it took them a minute, right, to get there.
It
took them a minute for them to learn how to reach across the aisle and collaborate. But when they did.
Yeah, no, there was phenomenal economic growth and markets did extremely well. So next point I think we want to emphasize here is if you look at presidents over time and how markets did during their tenure, this is a super fascinating thing to look at. So if you look at the 13 presidents from Eisenhower till present, you can see how markets have done over time. And so you can see in 11 out of the 13 presidencies, markets have been up on average. The two exceptions are the Nixon administration and Bush 2. Those are the two where markets were actually down. But you can see it's a pretty mixed bag. Eisenhower, who was a Republican, he had better markets than Kennedy or Johnson. Nixon had worse markets than either. Ford had better markets than Carter. Reagan had good markets, as did Bush. Clinton's were even better. Bush 2 had poor markets. Obama had strong markets. Trump had extremely strong markets. And Biden has had good markets. And so it's hard to pull out any discernible trend there.
Well, and that's my takeaway. When I look at this chart, when we study statistics, one of the things that we're looking for are trends. We're trying to understand patterns of behavior and how certain events will, help us get informed information around what might happen in the future. And I look at this and I'm having a hard time extrapolating any rhyme or reason as to what's going to happen next based on what I'm looking at.
Yeah, and I think you could take a statistician or a mathematician and try and pull out any correlation or themes or trends on this, and I think they would be hard pressed to do so.
Which means my takeaway is, the S&P over time is growing, regardless of kind of which direction the political leanings or the control is falling, and it's hard to really pinpoint, what's causing that.
Yeah, and I think one thing I'll share regularly with our clients, Paul, is this notion that the companies that comprise our economy, they are going to do their darndest to make money regardless of who's in the Oval Office. They're not going to say, hey, our person didn't get elected, therefore we're going to kind of mail it in for the next 4 years. They are going to adjust to any policy changes, and they are going to try their best to innovate and make money, and that's the beauty of the American system.
Yeah, when you have capitalism as your backdrop, the idea is selfishly people are actually trying to make money. And so the goal there is these corporations are going to do that regardless of the environment they're operating in. They'll find ways to innovate, they'll find ways to endure, and they'll find ways to grow. And I think that actually speaks a lot to the resiliency of our nation as well. To have the ability to kind of say, hey, we'll work towards economic growth in spite of which political power is pulling and pushing.
Absolutely. So I think the next thing we want to maybe look at is just the proposed policies from both Trump and Harris as it pertains to capital gains and dividends and individual income taxes. And as we all know, there's a pretty big gap with politicians of all stripes between what they commit to and then what actually happens. So take that with a grain of salt. But these are the policies that have been put out there. Trump hasn't put out a lot in terms of his proposed policies around capital gains and dividends. Harris is proposing to increase the top rate on long-term capital gains to 28% and the net investment income tax to 5% on income above $400,000. And as it pertains to individual taxes, there's a little more here that both of them have shared. So Trump has said that he wants to make expiring individual income tax from the 2017 Tax Cuts and Job Act permanent. So the Trump tax cuts, he would love to see those become permanent.
And as it currently stands, are scheduled to sunset the end of 2025, correct?
Correct. So yeah, barring any action, things will revert to what they were pre 2017. So he wants to make those permanent. He's put out there replacing income taxes with tariffs. He's talked about expanding the child tax credit, unlimited itemized deductions for SALT taxes, exempting Social Security from taxation, exempting tips from taxation, and overtime pay from taxation. And interestingly, Harris and Trump both have some common ground on expansion of the child tax credit, exemption of certain types of income. So there are some commonalities there. Harris has said that she'd like to increase the Medicare tax on 5% of income above certain threshold, and then has also talked about expanding certain housing tax credits. So while there are some definite differences there, I will say that there are some commonalities as far as expansion of the child tax credit and some of the exemptions as far as income goes. The one item I think we want to spend a little bit of time on is the Harris campaign has said that they endorse a proposed tax by President Biden around unrealized capital gains. And so, Paul, maybe you could spend a minute just walking through what this proposal kind of entails.
Yeah. This is an interesting one. I always, we hear the grumblings. We've heard the grumblings about these kind of concepts for years. And I think kind of what's pushing this along is you have some billionaires out there who have built, these massive corporations, right? Elon Musk's and Jeff Bezos and others, and their wealth is tied directly to the ownership of these massive corporations that they've built. And we're talking about hundreds of billions of dollars in wealth. And so there's been kind of this sentiment that says these guys need to pay tax on that wealth. It's really, really nuanced. It's really tricky. How do we exact a tax when they've never realized a gain? What they've done is they've built something, and that thing that they've built has grown in significant value, but they've never sold that thing. So there's not a gain to be realized. As a nation, we are $34 trillion in debt. And so you can see there's an appetite amongst a lot of people out there to try to find ways to come up with revenue and to pay this debt off and ensure that we're not going to be in any major problem. So this is one of these points where they're saying, let's come up with a way to tax people that have appreciated asset value that has never been sold or realized, but we want to tap into that appreciated asset value. And so right now they're starting this conversation out by saying we're only going to have it impact the highest net worth people, right? Where you have to have above $100 million threshold in order to have, to be, tied to this potential tax policy. But there's going to come up with a way to report unrealized gains and then one proposal is saying we want to have a 25% minimum tax on all the income if they're at over $100 million. So they right now the application would really impact just a very small fraction of Americans.
Yeah. And I like that explanation, Paul. And the way I think about this is, say you have a home and it's worth $1 million. The next year, the county comes out and says your home is now worth $1.1 million for purposes of assessment. If that type of asset was subject to a unrealized capital gains tax, the homeowner would be on the hook for taxes on that $100,000 gain that they realize. And I'm not suggesting that's the proposal, because that's not what the proposal is. But conceptually, that's kind of how that works. And then it begs the question, well, what if the house goes down to $900,000 in the following year? Is there some kind of rebate?
Do I get a tax credit? Right. So the administration of this becomes really, really tricky.
Yeah.
Because we see this in the equities market, right? Where I can own shares of Apple that have appreciated in value, and then assuming that this tax would apply to me, I would be required to say, okay, it's gone up in value so much that you now have to pay a tax on those Apple shares, even though I've never sold those Apple shares. So I've never received any of the benefit of the appreciation. Now, in theory, I would have to come out of pocket somewhere else in order to pay the tax due on the appreciation, or I'd be forced to sell those Apple shares. So that's really tricky. What if I don't have the cash in hand to pay the tax due on the appreciated asset? Now I'm forced to sell the asset. And to your point, Scott, this gets really tricky where we say, well, what happens when the asset goes backwards in value? It actually loses value, and I've already paid a tax due. Do I now get some kind of a tax credit? And right now, there's not a lot of clear answers on how they intend to move this forward.
Yeah, and I think the interesting thing with taxes and with a lot of policy generally is when a new precedent is established, you do kind of cross the Rubicon to some degree. And I think a good illustration for this is when the income tax first came into being. It was in 1913. It was not permitted under law. There's actual amendment to the Constitution, the 16th Amendment permitted income taxation, and then the Revenue Act on the back of that enabled taxation of income on a going forward basis. Any guesses, Paul, on what the income tax rate was initially in 1913?
It's going to be very low. I don't have a good guess.
So 1% on incomes above $3,000, and it was 6% on incomes above $500,000.
There you go.
So this tax only cut the upper echelon of the 1% back in the day, but because that precedent was established and because funding needs happened on the back of World War I, the Great Depression, World War II, the net of taxation expanded dramatically. And the concern is when a new concept like tax on unrealized gain gets opened, that Pandora's box can then bleed over and impact much wider swaths of the population.
In other words, the precedent has been established to say, hey, we need to build the policy and get it across the line so that we can kind of call this the new normal. And once that's there, then the concern is, now does it get more broadly applied beyond just what our initial understanding of what that policy would look like? And that's that term slippery slope, and we do worry about that.
Yep.
Let's talk finally about the necessity of staying invested, right? Letting cooler heads prevail and staying invested. This came out just yesterday. BlackRock kind of published their investment findings, and this was one of the charts I pulled from that report. If we invested $1,000 just 70 years ago, but we invested that money only during periods of time where the Democrats had control of the government, or if we invest that money only during periods of time where the Republicans had control of the government. And the third blue line is if we had invested that money the entire time, regardless of where the power was being held. You can see, obviously, we're talking about significant differential outcomes. And so the takeaway here is time in the market is always going to be more valuable than timing the market. And it's critical that we can stay invested and have a good, solid plan to be invested for a long period of time. This month we got a number of good questions, and so we had to select one that we'd share with the audience today. It's what might be the economic effect of the GOP and Democratic proposals for significant increases in tariffs on imports? Are they likely to be passed on onto the consumer? Are corporations likely to absorb some of the tariffs? And what might economic effect be of retaliation by countries that import U.S. goods?
I like this question a lot, Paul, and this is one where I do want to tread lightly because there are strong feelings on kind of both sides of this question. But I will say, as we think about tariffs and we think about protectionism and some of the things that are being floated there, I think there's two kind of things to consider. One is certain industries and certain parts of the economy have kind of significance as far as our national security. You think about chip production and other things, and medications and prescription drugs and what have you, and those supply chains are critical for our national security. And so I think there's been folks on kind of both sides of the aisle there who've said, hey, there are certain industries that have been entirely outsourced to other areas of the globe, and because of that, we have supply chain exposure and we have risk by not having some of those things sourced locally. So there's kind of that part of the argument, and there's, I think, a lot of agreement from kind of both sides of the political aisle on that point. But then there's also the idea of, hey, we want to protect American industries, and we want to limit maybe trade with some other countries, and we can do that via high tariffs. And if you look at classical economic theory and a lot of the body of economic research, tariffs aren't efficient economic vehicles. In free-flowing capitalistic trade, capital gets allocated efficiently, goods are produced where they can most cheaply and efficiently be produced, and then the consumer is the net beneficiary of that. And if we look at the globalization that has taken place since the 1990s till present, that is one of the reasons why the standard of living across the globe has risen. It's one of the reasons why consumer goods are so inexpensive today relative to where they have been in the past. And that's not to discount the inflationary cycle that we've been through, but on a global basis, free trade has been something that optimizes economic efficiency.
Yeah, I mean, I think a good example here, I often point to a TV I have on the wall in my office, and it's this nice 60-inch flat screen TV. And I'll tell my clients, I'll say, if I were to have purchased that TV 25 years ago when my wife and I first were in college, that TV would have cost me $3,000-$4,000. Today I bought that TV at Costco for $300-$400. And so you see how the free market tends to be better for the end user when you allow for capitalism and Adam Smith's invisible hand to actually kind of work out the kinks. The end user tends to benefit from that. And so anytime we put too many regulations in that free-flowing market, we worry a little bit about how that's going to impact the end user.
Yeah, and if we look at it, tariffs specifically, the intent with those is to encourage domestic production and make foreign goods much more expensive, where domestic producers can be a little more competitive, if you will. But that tends to be inflationary by its very nature, and so there is some of that to consider. Now, I will say this is a highly nuanced discussion. I mean, you have stuff like, well, what if certain countries are mistreating their workers, and there's human rights considerations that gets baked into the cake, and then the national security arguments I had. So this isn't like a black and white run one right way, one wrong way. But I do think that there are proven economic concepts as it relates to tariffs that policymakers would do well to consider, because tariffs do tend to be inefficient from an economic perspective, and they can be inflationary.
Yeah, good stuff, Scott. Finally, we want to close out our episode with a planning tip. And we actually got a couple of questions that were already kind of leading this direction, so we thought we'd just kind of meld it all together. You guys, there's a general sense that taxes are on sale right now. And so a quick planning tip to consider is right now there are kind of steps on capital gains taxes. And if you have less than $94,050 in reported income for the year, you don't pay a tax when you sell appreciated assets. So there will be no capital gains tax due. An example is we had an individual in the office who retired recently. So far for the calendar year, they don't have any income. And so what we've done to help them kind of sustain their retirement this calendar year, they're not quite drawing Social Security. They had this IRA account. This is a healthy amount of money, but they're deferring drawing on that for now, for this calendar year, because of this tax on sale conversation. What we're looking at is they had a brokerage account with several $100,000 of long-term capital gains that had gone unrealized, and they were worried about, how do I dig myself out of this? These long-term capital gains have gone unrealized for a long time. So we were able to say, hey, this calendar year, without any income to show, without Social Security and no distributions from 401ks, we can distribute $94,050 from that brokerage account, sell those shares. We can take an additional $29,200 because of the standard deduction, which would bring his adjusted gross income down below the threshold. And he also wanted to make a charitable donation of an extra $15,000. And what he did was he just took that money out of his appreciated shares and donated those in kind to his charity of choice. All in, it gave him about $138,000 that he was able to take out of his brokerage portfolio and use that for charity, use that for his day-to-day living expenses, freed him up of a significant tax burden that he'd been kind of worried about looming over his head. And at the end of the year, he won't pay any capital gains tax or any income tax on any of that money. So there are opportunities today to kind of leverage some of these taxes are on sale concepts, and knowing that the sunset is the end of 2025 for what capital gains taxes are today kind of puts us in a position where we are encouraging that conversation today. What can we do if we've got significant long-term capital gains built up into our portfolios and we've not addressed that? Now is probably a good time to reach out to your team here at Alliance Wealth and let's have a conversation about how we can come up with some strategies to help you kind of get out from some of those tax problems.
Yeah, and I think that also applies to Roth conversions and other topics where, in all likelihood, rates are going to be quite a bit higher in the future, tax rates that is. And so as a result, if we can take a little bit of medicine now at lower tax rates, it's going to be beneficial.
You guys, we appreciate so much the chance to be with you today. Scott and I kind of worried about this conversation for weeks leading up to it, but we felt it was a vital conversation to have. Our hope is that we were able to give good information today without stepping in anything, right? To give you good information and helpful information without triggering anyone thinking that we were revealing any political leanings, because we're not. We just want to be truly a resource to your families as you guys are working your way through this journey in retirement. And our goal at Alliance Wealth is to be a very good resource for you guys as you make this journey, and financial partners with you to give you guys good information. So hopefully we accomplished that today. We appreciate everyone jumping on the call. Until next time, thanks everybody.
Thanks.